This is your LMAX exchange technical update for Tuesday, June 6, 2017. Euro dollar. So the euro continues to extend its run of 2017 highs, and the focus is clearly now on next key medium-term resistance, which comes in the form of the August 2016 peak at 113.67. At this point, if we see any setbacks, they're expected to be very well supported into dips, with only a breakback below 111.10 to take the immediate pressure off the top side. Sterling dollar. So cable continues with its amazing consolidation above that previous peak at 27.75. The breakout above that level is significant because it forces a shift in the structure on a medium to longer term basis and suggests that the market could be poised for fresh upside over the coming days and weeks towards the next key measured move extension at 135. At this point, if we do see setbacks, which are possible, they're expected to be very well supported on dips into the 125 area, with only a breakback below 123.60 to compromise the newly adopted, highly constructive outlook for sterling dollar. Dollar yen. So dollar yen overall remains pressured on the downside since the market stalled out several days back ahead of 115 at 114.37, and this sets the stage for a potential retest of the 2017 low that was seen back in April, just ahead of 108. If we do see any rallies over the coming sessions, they should be very well capped ahead of 112, with only a break though back above 114.37 to compromise the bearish outlook for dollar yen. Euro Swiss. So Euro Swiss continues to show signs of stalling out and rolling over after the market just fell short of reaching a test of psychological barriers 110, and the stalling out ahead of 110 is significant as it keeps the more medium to longer term pressure now on the downside, with the possibility of the market now accelerating back towards some critical support down ahead of 106. At this point, it would take a break above 110 to force that shift in the structure, and again, until then, the pressure remains on the downside. Aussie dollar. So although we've seen Aussie bounce out in recent trade, the market is expected to be very well capped into rallies while it holds below a lower top at 76.11, with a fresh lower top now sought out somewhere ahead of 76.11 to be confirmed on a break back below some recent support that we saw around the 73.30 area, which would then accelerate declines back towards the December 2016 base around 71.60, only back above 76.11. That's the high that we saw back on the 17th of April, would compromise the bearish outlook. Dollar CAD. So dollar CAD has seen some setbacks over the past couple of sessions, but overall it looks like the market's wanting to try to put in a higher low now in favor of resumption of a more well-defined uptrend, a break eventually back above the 2017 high just shy of 138 that was seen in early May would expose a fresh upside extension towards the 142 area. At the same time, if we do see setbacks extend over the coming sessions, so long as they hold above 132.20, a previous higher low, the outlook continues to be constructive. Only back below 132.20 would compromise the constructive outlook for dollar CAD. Kiwi dollar. So the New Zealand dollar has taken out some key resistance in recent trade, breaking back above 70.90, and this does take the immediate pressure off the downside. Still, overall, any rally should be very well capped, ideally now ahead of 73, in favor of another topside failure and the market rolling over back towards a retest of the 2017 low at 68.18. At this point, though, we would need to see a break at a minimum back below recent support around the 70.35 area to put the pressure back on the downside and suggest that the market is ready for a bearish resumption. Only back above the 73 handle would force a potential shift in the structure and put the pressure officially back on the top side for a retest of the 2017 peak at 73.76. SPX 500. The S&P 500 has broken out to fresh record highs in recent trading days, and this does expose a measured move extension up towards 2480 over the coming days. This follows a period, an 80-point range between 2400 and 2320 that was seen between the early March down to late March, and then at that point the market continued to consolidate in that 80-point range before breaking out, again projecting a measured move of 2480 further up. Ultimately, though, if we do see the market roll over, it would need to break back below 2320 to force a meaningful shift in the structure. On a very short-term basis, the market would need to break down below 2400 to alleviate short-term topside pressures. But again, overall, this is a very strong trend and continues to suggest further upside towards 2480 over the coming days. Gold. So gold continues to carve out what looks to be a major bottom after the market stalled out in 2016 ahead of 1100, and the market is now putting in a series of higher lows and higher highs, with the most recent higher low sought out in the 1215 area, which would be confirmed on a break above the 2017 high at 1296. A break above that 2017 high would also open the next measured move upside extension towards a retest of that 2016 peak at 1375 further up. If we see any setbacks over the coming sessions, look for them to be very well supported, and again, only back below 1215 would compromise or delay the constructive outlook for gold.